Welcome to this explainer. Okay, today we are unpacking a really fascinating financial mystery. We're looking at this glaring contradiction in the market right now. A scenario where a massive earnings beat by a global luxury conglomerate resulted in an absolutely brutal stock crash. I mean, how does a company do everything seemingly right on paper, only to have the market aggressively punish them for it?
To understand this whole puzzle, we really have to start with the sheer strength of the underlying business. Just look at this number, up 14%. On paper, Tapestry, the parent company of Coach, Kate Spade, and Stuart Weitzman, they just delivered a blockbuster fiscal year 2026. They posted a 14% increase in full-year revenue, driving their top-line sales up to $8 billion. And honestly, what's even more impressive is that this meant they hit their long-term, 3-year financial targets 2 full years early. They scooped up 11 million new customers, with a huge chunk of those being Gen Z. So by all traditional metrics, we are looking at a company firing on all cylinders.
Okay, let's dive into this, because, well, here is the plot twist. Minus 21%. In the single week following this supposedly stellar earnings report, Tapestry stock plummeted 21%, dropping all the way down to around $129 a share. This wasn't just some mild everyday pullback. This was a severe, undeniable market rejection.
Now, what's genuinely wild here is that it proves the sell-off absolutely wasn't because of a bad fourth quarter. Grounding our investigation in the actual Q4 reporting documents, the financial strength is just undeniable. Tapestry reported an incredible 77.8% gross margin, meaning their core profitability actually jumped significantly from the prior year. On top of that, they posted earnings of $1.32 per share, which easily beat Wall Street estimates. So think about it. They beat on the top line, they beat on the bottom line, and their margins actually expanded.
So why the aggressive sell-off? To solve this mystery, let's look at clue 1, the shrinking beat. And this right here brilliantly illustrates what analysts are calling the beat and sink pattern. If you look at the progression over the last 3 quarters of fiscal 2026, a very clear, and to investors incredibly alarming trend emerges. In Q2, they beat EPS by almost 23%, and the stock naturally jumped. In Q3, they crushed EPS by nearly 30%, but the stock fell 10%. Now in Q4, the beat was much, much narrower, just 5.6% on earnings and barely 1% on revenue. The market is looking at this shrinking margin of victory and pricing in some severe deceleration. The beats are getting smaller, and the market's reaction is getting increasingly violent. In other words, yeah, they're still winning, but they are winning by less and less each time.
And that internal divergence brings us to clue 2, a tale of 2 brands.
When we pull back the curtain on the individual brands, the concentration of success is stark. It's actually a little shocking. On the left, you have Coach. Coach is an absolute powerhouse right now, delivering over $546 million in operating income and boasting a massive 24% yearly revenue growth. But contrast that directly against Kate Spade on the right. Kate Spade suffered a 7% revenue decline and actually posted a nearly $29 million operating loss for the quarter. Tapestry's financial health is heavily concentrated in Coach, which made up 87% of the total overall company's sales. So the market is looking at Kate Spade's struggles and wondering, is this an anchor dragging down the whole luxury ship?
With that reality in mind, it really begs the question, is the market mispricing a compounder? Let's look at the bullish fundamentals.
Management is definitely not being shy about leveraging their cash flow to reward investors. In fiscal 2026 alone, Tapestry returned $1.7 billion to shareholders. Moving forward, thanks in part to their terminated merger with Capri Holdings, they've unleashed a massive new $2 billion share repurchase program. Add to that a 16% increase in their dividend, bringing it up to $1.85 per share, and what you have is a massive capital allocation strategy that puts real, tangible cash into investors' pockets. And Wall Street definitely notices this. Right now, there's 16 buy ratings on the stock and exactly 0 sells.
To put the valuation into perspective, without getting bogged down in too much financial jargon, just consider this. Tapestry is trading at roughly 16.6 times its expected earnings. For a company keeping nearly 78% of its sales as gross profit and generating massive free cash flow, this suggests the stock is fundamentally cheap compared to its luxury peers. Value investors look at these metrics and they see a deeply discounted cash-generating machine.
But if the valuation is that good, why are traders rushing for the exits? Let's transition to the bearish reality check and uncover the cracks in the foundation.
A massive concern for Wall Street right now is where Tapestry's future growth is actually supposed to come from. This chart visualizes their heavy reliance on international markets, specifically China. Roughly 70% of Tapestry's future growth dependency is tied up internationally. For investors, this introduces a massive amount of execution risk and direct exposure to Chinese consumer sentiment, which, as we know, has been notoriously volatile recently. It's a high-reward but highly risky basket to put 70% of your growth eggs into.
And then came the guidance. This was really the match that lit the powder keg. Tapestry guided their fiscal 2027 sales to a midpoint of $8.45 billion. The problem? Wall Street consensus was expecting $8.464 billion. In the incredibly high-stakes game of luxury retail, even a slight miss on forward guidance fuels the narrative that the company's growth curve is flattening out. It essentially tells the market, hey, our best days of surprise upside might be behind us for a while.
When you combine that softer guidance with the shrinking earnings beats we talked about earlier, the technical traders take over. Looking at the financial tables here, contrasted with market momentum, the daily chart actually flashed a strong sell as technical momentum indicators absolutely plummeted. The stock decisively broke below its key moving averages, and, when charts break this hard, computer algorithms and momentum traders automatically sell first and ask questions later. They completely ignore those 78% gross profit margins that we were just raving about.
So it's time for the final verdict. The crucial point here is synthesizing these two totally different realities. We have a fundamental powerhouse aggressively returning capital to shareholders on one hand, and a stock showing a terrifying technical breakdown with flattening growth on the other. Which brings us to the ultimate question you have to answer for yourself. Is Tapestry a falling knife that you absolutely shouldn't try to catch until the technicals stabilize and Kate Spade turns around? Or is this a rare luxury discount? A chance to buy a highly profitable, dividend-raising compounder at a total bargain bin price? The data makes a really compelling case for both. It all comes down to whether you're a short-term tactical trader or a long-term value investor. Thank you so much for joining me for this explainer, and I highly encourage you to dig into these numbers and decide for yourself.